Chapter 6, Money Market Instruments. Treasury Bills. Treasury bills are short-term bonds, maturity less than 1 year, issued by government in order to help them raise short-term liquidity. TBs are discount instruments, meaning that they are sold at a discounted price with a holder receiving the face value of the TB at maturity. The price differential between what the TBs are purchased at and what their face value is represents the yield on the instrument. Governments issue TBs weekly via auctions held through the Reserve Bank. The yield on a TB represents the lowest obtainable yield in the money market because the government of a country should theoretically represent the lowest risk borrower in a country. The main investors in TBs are banks. If banks need to borrow short-term liquidity from the Reserve Bank, they post their TBs as collateral. TBs are also used by banks to meet regulatory requirements imposed on them with respect to their reserves and balance sheets. Banks are required to hold reserves and capital, which are to be in line with the deposits that they have and the loans that they advance to their customers. Due to their low risk, TBs are always in demand by banks to be held on their balance sheet and to be replenished as the TBs mature from time to time. TB auctions work as follows. Bids are submitted through online auction systems. In South Africa, the Money Market Internet System, or MMIS, but bids can also be submitted telephonically. Bidders submit price bids quoted as a percentage of the 100 nominal face value they are willing to pay. In South Africa, this would be in rands, and the bids would be rounded to the nearest half cent per 100 rand. The settlement date on the Treasury bill auction is T+3, meaning that the bond tenor would begin 3 business days after the date of auction. In the secondary market, once the TBs are being traded, prices are quoted at full precision and payment is made to the nearest cent. This can be illustrated by means of an example. The following page is taken from the South African Reserve Bank for a TB auction held on the 21st of February 2020. Note the following. The settlement date is T+3, meaning that if the auction took place on the 21st of February, the TBs would only become effective 3 working days later, in other words, on the 26th of February 2020. The maturity dates for the 91, 182, 273, and 364-day TBs are calculated from the 26th of February and not from the 21st of February. The results for a TB auction held on the 14th of February, the week prior, are shown below. Let's analyze the 91-day TB results. Settlement date. The auction was held on the 14th of February 2020 and had a T+3 settlement. Therefore, the settlement date, or the date on which the TB began trading, was the 19th of February 2020, in other words, 3 business days after the 14th of February. Maturity date. This was calculated 91 days from the 19th of February. Be careful to note that 2020 was a leap year, and this gives us a maturity date of the 20th of May 2020. Amount received and amount allotted. When submitting bids, bidders indicate the amount of TBs they wish to subscribe for and the prices at which they are willing to subscribe for these short-dated bills. In total, the government received bids for 2.079 billion worth of 91-day TBs. The government, however, only issued 879 million in 91-day TBs. Therefore, the TB was oversubscribed. This usually happens in practice. The implication is that not every bidder would receive the total amount of TBs they bid for. The bids would be ordered from highest price to lowest price, or lowest yield to highest yield. And the TBs would be allocated to each bidder at the price they bid for, from highest to lowest price, until the government allocated all of the bonds offered in the auction. Those bidders who bid too low would receive no bonds if the government filled its book at higher bids. This ensures a competitive process for government, enabling them to raise funding at the most cost effective manner in the market. Just bear in mind that in the South African market, the bids are filled from highest price to lowest price, and each bidder receives the price at which they bid for. This is different to a Dutch auction, where in many European markets, the bids are ranked from highest price to lowest price. And at the bid at which the government manages to fill its book, that is called the closing price. And every bidder receives the closing price regardless of their bid, if their bids are higher than the closing price. So this is of benefit to the bidders because, for instance, if a bidder bid 99 euros per 100 nominal, but the closing price was 95, then that bidder who bid 99 would pay 95. So as long as the books were closed at 95, every bidder would receive 95, and that's how a Dutch auction works. Full allocation. This is the lowest price at which a bidder received the full number of TBs they bid for. Part allocation. This is the price at which bidders received only a percentage of their bid amount. In this example, the part allocation percentage was 22.54%, which means if a bidder put through a bid of 100 million rand, at the part allocation price, they would have only received 22.54 million. Average price. This is a weighted average of the prices of all the successful bids that were received during the TB auction. Highest price. This is the highest bid received during the auction. Remember, the higher the bid submitted, the lower the investor's implied yield would be on the Treasury bill. Hence, government would aim to allocate the bids offering the lowest yield or highest price first, as this ensures that the government incurs the lowest possible funding costs. Average discount rate. This is the average discount rate paid by the government across all the bonds it allocated. We will illustrate the calculation methodology for determining a discount rate given a TB price for an arbitrary bid of 98.45 per 100 nominal. We will use the following formula. Price is equal to the face value, which is just 100 in this context, multiplied by, in brackets, 1 minus D, 91 over 366. And the 91 just comes from the number of days between the trade date and the maturity date, and 366 because in South Africa we use an actual over actual or actual over 365 day count convention. 366 days represents the actual number of days in the year, since 2020 was a leap year. So plugging these values into our formula, the price that we paid, or the price that was bid, is 98.45. And then we just need to solve for the equivalent discount rate that that price implies. So after algebraically manipulating the expression and simplifying, we see that a bid of 98.45 would equate to a discount rate of 6.23%. Average yield. The yield is the interest rate earned over the tenor of the TB. There is a direct relationship between the yield and the discount rate. Generally, the discount is received at the beginning of a period, whereas the yield is received at the end of a period. We will determine the yield from the discount rate, given in the example above, and one can easily convert between the two rates using the formula we saw before. I, the yield, is equal to 1 over n, multiplied by, in brackets, 1 over 1 minus nd, minus 1. Substituting the value for d and the value for n, which bear in mind is just 91 days from the settlement date until the maturity date, divided by 366. So substituting all of these values into that formula, we arrive at a yield of 6.33%. TBs outstanding. This refers to the total amount of previously issued Treasury bills of this specific tenor that are still being traded. In this example, there are 14.83 billion 91-day Treasury bills currently in issue in the South African market. ISIN. This is a unique identification number for the bond issuance in question. Each 91-day auction would have its own unique identification code. Similarly for each 182, 273, and 364-day bond.